You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we break down all of these sometimes scary, sometimes complex, sometimes just intricate world of options and explain how you, the busy financial advisor, asset manager, maybe you're someone looking for those services for yourself, how you should be using these products, how you could help your clients use these products, or what you should be looking for in an advisor if you are looking for them. Right now, I'm guessing a lot of you probably are interested in such services right now. My name is Mark Longo from the aforementioned network, as well as, of course, from theoptionsinsider.com. Happy to be back on the old program. Make sure you can catch us live or indeed after the fact, However you listen, make sure you send in those questions, those comments. We do indeed love to hear from you, and so do my cohorts. Joining me on the program today, first, let's kick it off with the Director of Risk himself, Mr. Chris Hausman, the Portfolio Manager, a.k.a. the Managing Director of Risk, a.k.a. the Director of Risk over there at Swan Global Investments. Mr. Director of Risk, welcome back to the program, sir.
Thank you very much, and I didn't know I had so many AKAs. I'm going to have to figure out something to do with all that AKA.
The law enforcement folks, don't blame me. You know, they're the ones who put these profiles together. We just read them here on the air. And also joining us, a man just known as Matt. Mr. Matt Amberson, the founder over there at ORATS. They have an AKA Options Research and Technology Services. Mr. Matt, welcome back to the program. To you as well, sir.
Thank you. We do live in interesting times, Mark, don't we?
We do. I was just thinking, there's not really a lot going on, so maybe we should just cancel the show this month. What do you think? Not a lot to talk about. What do you think?
Yeah, it's tough to find things, but let's push ourselves and find something.
All right, we'll soldier on. Just for you listeners, just for you folks out there, we'll keep going as we head on into the buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options. So we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz, the portion of the program where we break down what is going on in the world of options and derivatives and volatility that maybe you overlooked, or maybe you're busy out there actually managing your clients' accounts. You don't have time to pay attention to such things as the world of options and volatility. So we do it for you. I should mention here at the top of the segment, we will be joined in a little bit, probably about 7 or 8 minutes or so, by our old buddy, Mr. Eric Cott, the Director of Education and Business Development, particularly for advisors over there at the OIC. As he is wont to do, he's running fashionably late, but we'll get him on the program. Good to have him back for the first time, indeed, this year and indeed this decade, so that'll be fun. But before we get to that, there is a lot of stuff popping off here in the buzz. My poor joke at the top of the program aside, unless you're under a rock, you've been paying attention to what's been going on out there. What a strange environment we find ourselves in now. We were talking about this on our last episode, which doesn't seem like it was a month ago we all got together here, but it was. And then now what we were talking about and everyone was hand-wringing about on the last episode seems kind of quaint by comparison. Coming out to the show last time, we were hand-wringing and worried about potentially the coronavirus impacting the markets at the time. The Dow had sold off about 454 points. Everyone was freaking out about that. Everyone loves the Dow, by the way, to have these massive point totals. They love quoting all the time. Of course, fast forward a month, and here we are back again, talking once again, you guessed it, about the coronavirus. Of course, those 400-plus point moves in the Dow seem quaint now, multiple thousand-point sell-offs out there throughout the course of this week as coronavirus fears really crashing into the market. This is something we were kind of debating on the show last time. Are we pricing this in accurately, or is the market kind of shrugging it off? At the time, it seemed like the market was shrugging it off. Well, not so this week. It's hitting with like a bomb this week, starting on Monday and going on throughout the week. In fact, today we were rallying. It seems like most of that rally has faded as we speak. And we saw some impressive numbers earlier this week. Our old friend VIX Cash topping out about 29.5 or so. Of course, if we keep on this pace, maybe we'll threaten that again. We'll see. Spikes at about a similar level, right around 29.5. VXX, a product that does nothing but go down, went up pretty strong this week, up to about 19.5 out there as well. So we're racing the better part of the last few months' worth of erosion out there as well. Now, all this has been interesting from an overall volatility, also from a volume perspective. Our buddy, the flow master, Mr. Schwartz, he put out an interesting tweet. He is the kind of keeper of all the flow data out there, and we just saw yesterday a new volume record for the overall options market. So options like themselves a little bit of volatility, a little bit of movement. Maybe not this much, but they like it nonetheless. A new overall volume record, 40.7 million contracts changing hands yesterday. That blew away, as according to Henry, that blew away the prior record set in 2011. And interesting footnote, exceeds the entire industry, the entire option market volume for the year back in 1977 by a few million contracts. So interesting stuff percolating out there. We did 40.7 million contracts the day before, the 24th. That was on the 25th. On the 24th, did 39 million, so a pretty hefty day there as well. You have to go back all the way to August 5th of 2019, where the volume was about 31 million, and then May 13th of 2019, where you have about 24.6 million. And and then in between there was August 14th of 2019 with 27.9 million. So interesting data. I encourage you to check that out. Speaking of data, Let's start with you, Mr. Matt. You have a lot of data on your hands. Your data was eerily prescient on our last shows, I believe. Everyone else was kind of fading this thing, and you were coming in there saying you thought this may have some legs, and you thought maybe we were in for a bit of a new volatility regime. And also our listeners agree with you. We got a listener here, Nilai, perhaps. If I'm butchering that, I apologize. Nilai saying, Matt nailed it with his prediction for vol last show. What are his models saying now? So, Matt, the listeners want to know. We want to know. First off, congrats. It's somewhat bad timing, but congrats on your earlier prognostication. Your models were clearly kicking in there. And B, what are your models telling you now, sir?
Yeah, I mean, part of what we do and see with accurate volatilities is you can get these indicators a little bit early when the market participants that might have some advanced warning or good models, they start to come in, and we could see those pretty well. So, what I look at, is the relationships between the volatilities and SPY, obviously, and the VIX as well. But in the volatility, is that kind of breaking out, and it was back about a month ago. Now, when there weren't too many people talking about it. So, how do I feel now? I think it's hit. I actually look at this market width and volatility. So, how wide is the market in SPY? And that what happens is when it gets really ugly, the market makers will, as you know, Mark, just widen out the market. That's when they're really panicking. They can't hedge their trades that are coming in, so they have to widen out the markets. That has increased a bit. I mean, it's increased the most in about a year, but it's not nearly up to the blow off that we got back in 2018 in December, nor at the Volmageddon in 2018 in February. So I don't know. This thing's still I still think that we could see some a little bit more carnage right now. It does seem to have a lot of the news is out. When I was talking back a month ago, some of my news outlets were mentioning things that weren't being mentioned in the mainstream media. Now they are. So we might get a little bit of a bounce here, but I think over the next, month or two, I think we haven't seen the blow off that we need to see. So, and I think it's going to be unfortunately pretty ugly. Probably, I don't know. I would even think of testing the 270 range, maybe 250 range. It's pretty bad, but that's what I called originally a 20 to 40% correction because of this thing, Mark.
So I just want to know, is there room in the New Hampshire compound in case we need to strategically move out of Chicago for a little bit? You and the Rock Lobster, both nicely situated in the hinterlands there.
Yeah, unfortunately, there have been some lines at supermarkets and that you see on TV, and it'll be tough to be in a city, but so many things are going in the favor of living a city now, including just delivery and just-in-time delivery. Now, how much is the supply line going to be cut? Who knows? But for right now, it seems like they're going to come through this. But again, I think the other shoe is going to drop here. And it might take them a little bit of time, but we've got a pretty good blow off right here. Might get a little bit of relief, and then I think there's going to be another leg down, and then on to the onward march upwards, as we're all been accustomed to over the last 15 years.
Yeah, it did seem like nothing could derail the bull for a while there. In fact, I was just remarking on this network not too long ago about how this bull market, this long-lived bull market, has withstood trade wars with our largest partners, potential shooting wars in the Middle East, large swaths of global crude production being wiped off the map, all these myriad things that would have derailed numerous other bull markets. And it seemed like in the beginning, at least, it was shrugging off this pandemic. And now, perhaps this week, it's finally starting to catch up with it. So sounds like Matt's models. If you were a bull and you were tuning in for a little bit more optimism, it sounds like Matt's models, easy for me to say, don't have that in store for you. Let's turn now to the director of risk Mr. Director of Risk, there's a lot of risk to direct these days. So what's been lighting up your tape, and what is your outlook on what we're seeing out there now from a volatility regime and overall market perspective, sir?
Yeah, I just want to congratulate Matt, and it's a good thing we didn't record any of these shows the week of Valentine's Day. But no, I saw the same signals January 31st through about February 7th-ish at the latest that Matt was seeing that there was potential for some downside, and we're seeing the same signals right now. So from a technical perspective, I've been pounding the table that we need to test that breakout, which is around 30.25 for months now. And the 200-day moving average is around 30.5. So I definitely think there is, in the short term, more downside to at least the 200-day moving average, and maybe we will get a relief rally at that point. But you're going to have some really good support at the 3,000 level. I think the 29.5, I'm talking about the SPX, 29.5, 3,000 is going to be a battleground for the Bulls and the Bears. And if that does break, then I think, what Matt just said is very feasible, going down to 2,700 at that point in time. And then we'll see if that wants to break, which will open up that December 2018 low, which would basically wipe out that entire year's rally. So, historically, selling the VIX at 28, 29, 30 in this area is a pretty good trade. But, I do think, we've got some unknowns now, and it's the virus news, and you can see that, markets were bouncing back today, maybe in a relief rally, and all of a sudden they came out and said that there were some potential cases in New York, and then I believe it was Cuomo came out and said, well, they all tested negative, and then futures rallied 20 handles in about 2 minutes. So things are jittery. I think the VIX is definitely going to stay elevated here. We just have too many unknowns. We don't know where the virus is going to spread, and I think finally, it is probably going to take a toll economically. 10-year rates were at all-time lows, I believe, yesterday. So markets are listening now. It's not the euphoria Trump tweet that everything is great and we're going to continue going to the moon type of environment. So it's very, very important right now. Good to be hedged, good to be invested and hedged. But you also have to be very cognizant and tippy-toe through income trades, which are short premium, right? There's going to be some defense. There's going to be a lot of rolling going on out there. And that's going to move the markets with the gamma shifting around as much as it could, with these larger moves.
Speaking of shifting around, we're going to shift around the host seats now because I do believe we are joined fashionably late, as always, by our old buddy, Mr. Eric Cott, the Director of Education and Business Development over there at the Options Industry Council. For the first time this year, and indeed this decade, Mr. Cott, welcome back to the Advisors Option Program, fashionably late as always, sir.
Well, Happy New Year to you, Mark, and to Chris and Matt. Always nice to be with you. I wish, I say this facetiously, I wish I had exercised the put for the technology that goes on in my building here down in the Southeast, because we had some disruptions due to weather that caused a little bit of an outage. So my Skype was a little bit off and the phone, but I am glad to be here. So thank you, gentlemen. Sorry for that with technology. You never know what can happen.
But you're joining us by that magic technology known as telephone. Very cutting edge, very avant-garde of you, sir.
We're right on the cutting edge. And I would sort of echo some of the sentiments of my colleagues that it's been a interesting week. And for me being at an advisor conference, the early part of it most certainly brought a lot of attention to the OIC booth, Mark, because I would say that advisors are not as complacent. And it was interesting because was with a colleague of mine from one of the exchanges who was trying to get back to your wonderful state and avoid that snowmageddon of 2020. And she definitely exercised the put and decided to leave at 5 a.m.
Well, I'm glad to have you on because I like to get the pulse of the advisor space, and you certainly are out there doing that. It sounds like you just kind of broke it down for us. In fact, we're going to have, spoiler alert listeners, we're going to get into some hedging strategies in a little bit, which I know a lot of you have on the brain right now. But it sounds like, Eric, as you've been going on, you spend your days, I know it's hard to believe, listeners, but he actually has things to do when he's not on this show. And he spends his days out there at advisor events and really getting the pulse of the boots on the ground advisor across the country. So it sounds like from your anecdotal perspective, Eric, that advisors are really starting to shape up and start paying more attention to this, whether it's the pandemic or whatever is driving their concerns here. They are starting to get more interested in, shall we say, the hedging side of the space, sir.
It's interesting, Mark, and I'm definitely going to have Matt and Chris weigh in, because Chris especially, given his team that I was with at a large RIA conference this month, and then hearing from advisors. Mark, when we all talked, the four of us, late last year, advisors were definitely hearing from their clients about some of the concern that was evolving around this year with elections and things that were going on. Obviously, I just heard some of the comments from Chris and from Matt that when clients start to call, the advisors who sort of separated themselves from the masses that have already been talking about some hedging strategies, I actually got some emails from some of those colleagues this week who were conveying the message to me that they were already being defensive and they were already sort of having that conversation way before this month. However, the majority of other advisors that have maybe been reticent are now contemplating, thinking about some of these ideas that I know you're going to talk about in a little bit, but, you know, having, I guess, that insurance policy there in place. So we've talked about this before, Mark, you know, that sleep well at night. So I think it's definitely when something like this occurs, and a lot of us talk about analogies, and it's sort of that, you know, once in a 100-year storm that comes in, well, there are things that are going on, obviously, in the capital markets and all around the world. And advisors have to be aware of that and be more proactive with their clientele.
Definitely. Well, you know, from your perspective, Eric, you know, I was just talking before you got on here on the show, volume-wise, which, of course, you come from OIC, which is part of OCC, which clears all these contracts. Volume-wise, it has been an interesting time. I just mentioned at the top of the show, we've set multiple daily records just this week on the 24th and the 25th, and we'll see how today plays out. So far, so good. But yeah, it's interesting from a volume perspective. I know January was also a pretty interesting month from your overall perspective. I believe, Mr. Cott, don't quote me, but I do believe, sir, it was the most active January on record. Is that the case, sir?
Well, it was one of the most active January on record, Mark. So I won't quote you on that, but in the top three, yes. As far as January goes, and we did set a record. You're right on Tuesday. You know, more than 42 million contracts, and knowing from the history that you and Matt and Chris do, being in this industry for, let me see, if I combine all three of you together, Mark, how many decades or centuries would that be? The three of you?
I don't know. I'm only 27 myself, so I don't go back that far.
But yes, to answer your question, and I'll, you know, is that it's absolutely remarkable and a real team effort on the part of OCC and OIC to see that level of trading.
Well, we're scaring people. We may scare you a little more when we get to the hedging a little bit. Before we do that, Matt, let's dial him back. Let's walk him back from the edge of the cliff. Let's look away from the macro focus for a second, because I know you guys have your fingers on the pulse of all things micro. And you may have forgotten, listeners, but it is still earnings season. There are still big names popping off. Some of that is getting lost now in just the furor over all things coronavirus, and big names are reporting big numbers, and they're kind of just getting washed away along with the tide. But there is still a lot of interesting vol and analysis to be done on that side of the fence. Mr. Matt, catch us up, sir. The keeper of the earnings data. Where do we stand so far? How are things progressing? How's the vol shaping up? And maybe any interesting surprises or takeaways from this season, sir?
Yeah, and I have to admit, I circled back to our earnings season report and only to find that it's now switched. So whereas the owners of volatility were getting hurt before owning earnings moves, now they're doing okay. So rest assured, Mark, the buyers of volatility around earnings have made a comeback. We kind of called that last time too. We said that, you know, as we move on into the earnings season, you know, we look at 6 weeks, and generally the first 2 weeks aren't very good for option owners, but then week 3, week 4 is usually the best, and then it kind of tails off after that, and that's what we've seen. Week 4 again, whereas historically you've had an 11% positive return in week 4, we saw a 17% positive week. Whereas it's usually about a break even. Now we've seen option owners are up 5%. So, Mark, the bright side, not the dark side, is winning this option season.
I like that. A little bit of optimism, but we know a lot of you have the dark side on the brain, so without further ado, we thought we'd have a nice, timely Options 101 for you.
It's time to learn how to use options to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the program where we break down how you, the busy advisor and asset manager, can utilize these options products in your own portfolio. We touched on this topic many times in the past. I encourage you, if you want a very, very deep dive, to head into the archives where we've touched on this before. But it's time to do an overview because, as Eric alluded to, everyone's got hedging on the brain these days. And market sells off, 1,000+ points in the Dow and other things, and VIX is heading in on 30. Go figure. People have some hedging on the brain. So we're going to get into that a little bit again because sometimes people, they can't be bothered to go back in the archives. They want it in their ears right now. So we're going to walk you through some basic and a little bit more advanced hedging strategies as well. Eric, before we get into that, you mentioned people were coming to your booth this week. Were they coming pretty much just to kind of dip their toes in and get a sense for basic hedging? Were they looking to get more involved? What was the general pulse of the clientele coming to the OIC booth this week?
It's interesting, Mark, that there is a lot of these advisors obviously follow the news, and all four of us know when you have volatility like this and markets have significant drops, every news channel is picking up the story and talking about it. So it's not only what's going on in parts of Asia and other parts of Europe and stuff. They're also following, these news channels are following capital markets. So advisors were certainly coming over and asking questions, about, what's the best way to start having this conversation, because, here we are, already down significantly. It's surprising when an advisor's been managing money for a long time would say that, is it too late to do this? And, are there some other, ways that I could introduce this where I don't have to manage it all on my own? Are there sort of solutions that are out there that I can kind of bring someone else in? And i.e., I'm kind of teeing up a little bit of our colleague out in Puerto Rico or down in Puerto Rico. Can I find someone out there that can help mitigate this risk where I'm not tied to my desk all the time and having to do that, constantly?
Yes, I can certainly see that, particularly in this environment. A lot of advisors, the time is an issue as well as expertise. So hopefully we can help with the latter. The former, we can't do much for you, unfortunately, listeners. But maybe, as Eric alluded to, maybe the director of risk and his crew over there can help you out. But let's outline some of these basic strategies you may be considering, and then we'll tweak them a little bit, get a little bit more advanced for you, maybe an Options 201 there as well, tell you how you can help pay for some of this protection that everybody wants. Because as Eric alluded to right now, people are asking, is it too late? Is the horse already out of the barn? And so you're looking at this strategy. Let's start off with our most basic defensive play here, which is the basic protective put. Of course, a lot of you are along the S&P, so you want to buy some percentage out of the money put. That's going to vary depending on you and your client's needs. Usually it's somewhere around maybe 3 to 5%, maybe a little more, maybe a little less, depending on how much protection you want out there right now. These days, that's going to cost you. So we'll get into the ways to pay for that in a second. But there are many pros to this type of strategy. First off, it gives you reliable protection. People often say, well, why do I need a put? I have my trigger finger. I can sit on the mouse button. And when it starts selling off, I can just hit that sell button, and I don't need that put. I don't need to pay for all that protection. Well, in the environment we find ourselves in now, things just don't happen in U.S. trading hours. Things happen overnight. We have huge gaps in the pre-hours and after hours. These are not times when stop orders are reliable. And if you get filled, quite often we'll get you filled far lower than perhaps you initially intended. So you don't want to get yourself caught in that. If you buy a put at a particular strike, guess what? You're stopped out. You're hedged at that strike. That's the value. That's the benefit of buying an option contract. The world can melt down. Well, as long as OCC is still around, you'll have someone on the other side of that contract to get you out at that strike. Now, the downside of all that nice, reliable protection, as I mentioned, it's going to cost you. So that's where people usually start scratching their heads and saying, well, maybe what can I do to mitigate some of this outlay? The most basic first step everyone takes as a way to mitigate that is taking that basic long put you just bought, 3% out of the money, 5% out of the money, whatever it is, whatever you decide it to be, and now selling a further out of the money put against it. Turn that basic put into a put spread. So buying one out of the money put, selling one farther out of the money put. So maybe let's say you buy a 5% out of the money put, you sell, let's say in this scenario, a 10% out of the money put. Now you've covered yourself in that 5% range. So the pros of that are going to be, well, it's going to cost you less because you sold the contract against the one you just bought. The downside of that, pun intended, is, of course, you can see by that example I just laid out, you're not protected beyond that 10%. So you have limited protection as opposed to the effectively unlimited protection that you had just buying the put itself. So those are just some basic scenarios. We'll get into more advanced ones. Maybe let's go around the horn first, though, and get everyone's thoughts and takes on these basic strategies, and maybe, as Eric alluded to, maybe is the horse already out of the barn. Let's start with the director of risk cert, because you spend your days pretty much doing that, as well as some of the more advanced strategies we're going to get to in a second. What are your thoughts on these advisors now who are coming to guys like Eric or other areas or listening to a show like this and saying, hey, maybe I should get into these types of hedging strategies, and your thoughts on these basic strategies and pros and cons of your basic long put versus your basic put spread, sir?
So one of our mottos here is always invested, always hedge. And the reality is because it's extremely difficult to time the market. Now, there's a saying, right, every dog has its day. I've always said every hedge has its day. There are better structures for short-term violent corrections, which we currently looks like what we're doing. And then there are other types of hedges that are better for more prolonged type bear markets where you're going to see those 20% plus moves to the downside. So it really depends on, what an advisor believes. Is this going to be the typical 7, maybe 10% pullback that we've been seeing, and then the buy the dippers are going to come back in? What if an announcement that there's a cure happens tomorrow? You don't think? I bet futures rally 100 handles in like an hour. Could be a snapback reaction. But shorter term hedging is going to be expensive after an event has happened. If you look at the April at the money put, it costs a little over 3%. If you annualize that, you're looking at a 23% cost if that pricing continues the rest of the year over the next 12 months. So it can be very expensive if you're going to hedge for short term environments. I think at this point, you need to be a little bit more tactical and maybe lean on put spreads, if you will. That's going to cut down some of that Vega exposure and some of that volatility exposure. Because right now, with the VIX of a 28, even though it could go higher, this is a really good entry point to sell premium. But if you're worried about more downside, as Matt and I have alluded, that there could be some more downside here, then you have to do, I know we're talking about hedging, but you have to do limited risk type strategies if you're going to take advantage of this high volatility. But is it too late? Again, the converse is cut down on some of the Vega if you're going to be buying premium right now, because if the market turns around, then it's going to deflate very, very quickly. 23%.
That's a lot of your portfolio to spend just to hedge for the rest of the year, listeners. Bear those types of costs in mind. Particularly, obviously, we're in an extreme environment right now, so those prices are going to be very high, but on the other hand, you get what you pay for. You get that protection a lot of people want out there. Matt, same question for you as you're hearing these advisors are starting to tiptoe over to Eric's booth and ask about hedging, asking if it's too late. What are your thoughts on that, as well as some of the pros and cons of these very basic hedging strategies of the long put versus the long put spread, sir?
Yeah, so I was doing the same things for my personal account and went and looked at those puts that are crazy. The cost, was amazing. But so were the very out of the money puts. So I was able to do a fairly wide, maybe a 20-point in the SPY put spread, and maybe I paid, $250 for it. So if you find a good relationship, you could still, you could buy one and sell another way out of the money and have a pretty good ride. And so that kind of worked out for me. It was so expensive that I couldn't just buy a put, but when you do it against something else, then that's when it can really work. So that's when I like the put spread. I still like the very long term. I'm talking, September of 2021, 7 delta or 10 delta or 15 delta. Those are the ones I just have in my portfolio at all times. Like Chris says, you can't really time these things. And it's nice to have those on because they don't decay very much. They're not very expensive. And in relation to the at the money of these ones in the market right now, and so there is still time, and I think you still want to be hedged. You still like I said, I still feel the market has a ways to go. It's kind of everyone's collecting themselves, figuring out what's going on, It's a very psychological thing that happens. It's the stages of grief I think we're going through in this market, and we're not quite through it yet. We have a ways to go. So, yes, there are things to do. I'd be very wary about selling anything naked. Or my old favorite strategy is buying one close to the money, selling two out of the money. I'm not doing that now because you just don't want to have any short units. I never really had short units because I'd always buy far out of the money put. Both strike and days to expiration. So I think there is time. There are some tasty looking put spreads in there. There's some skews that are a little off. I like to just go in and do some hunting and pecking for those relationships. Where do you think the market is going to go? Where do you think it'll collect itself? So maybe that's the put you sell and you buy the put nearer to the money. So those are the types of things I'm looking at, Mark.
Interesting. That's the old market maker in you picking up some 7 delta puts just in case. You never know, right? So when those bad boys could come in handy, always pays to have a few bullets in the old chamber for events like these, and that's interesting in and of itself, listeners. Then you're right. The put spreads, if you're savvy with them, if you play with where you sell that second leg and take advantage of some of that dramatically overpriced put skew out there, maybe you can find levels that are certainly more attractive than just going out and buying, I think as Chris said, 23% for the year at the money puts there in SPY and SPX. That's a heck of a lot to do to your portfolio, listeners. Now, some other ways. Let's get a little bit more advanced, get a little bit options 201 here for some other ways to pay for protection. I've joked before on this program and on the network that a significant percentage of the options industry spends their days looking for ways just to pay for puts. So if you're doing this yourself now, listeners, you're not alone. Quite a few brilliant minds are doing the exact same thing. A lot of interesting ways to do that. Let's start with what we termed in the past the holy grail position for advisors. And this is the basic collar. So now you're taking that S&P put that you just bought, let's say 5% out of the money in our example, and you paid a lot for, as Chris just alluded to. And you take that and now you say, well, okay, I'm going to start looking for ways to offset some of this. And, if the S&P continues to rally, let's say up 5%, I'm okay selling the S&P at those levels as well. So I'm going to turn around and sell now a covered call against my long S&P portfolio. So now if it rallies 5%, I'm going to sell the portfolio. I got that call income coming in. It's not going to offset the price of that put because, as we all know, puts are more expensive than calls in broad equity indices, particularly in an environment like this. But it's going to mitigate some of the cost of doing that. And then you could always turn around and do the collar with the kicker, which is effectively you have that collar, you sell the covered call, you buy the put, and now you do what we talked about before, that put spread. So you buy the 5% out of the money put, you sell the 10% out of the money put against it. Now you have that range at which you're protected to the downside. And then you turn around and sell, in this example, a 5% out of the money call. So now you have 2 income legs that are helping to pay for that one long premium leg. So your hedging is going to be limited to that 5 to 10% out of the money range, but still, you're not going to pay a ton for it as well. So that's another way you could approach it and get active with some of your trading. And there are many others as well. I could explore some more, but let's go back around the horn. Let's start with the Director of Risk, because Mr. Director of Risk, this is what you do. When you're not talking to me, this is how you spend your days, sir, which is getting out there and implementing the Swan DRS, which, as you mentioned, is a hedged equity portfolio. So you have the put, you like your long-term puts in the DRS, but then you're also writing nearer-term premium against it. So walk us through what are some of the ways you like to go to pay for your protection, sir?
It's a great question. Everyone's pretty familiar with the risk premium, and even though there's been some compression over the last few years because of a lot of entrants into the business and just the way the marketplace has been trading, and I'll refer to times like this, it's very important to have some bullets or to keep some powder dry. Obviously, selling premium or selling puts and then having the market drop, 7% in 5 days is not going to be good to any short premium, any short premium program that's not delta hedged at least. So it's important to have some bullets free. It's important to, this is where risk management comes in. Basic rules like don't let options go in the money. Always monitor that kind of thing, monitor risk. Things change right now. It's kind of like, like our traders on the desk. I mean, we are in high vol mode, which means don't work your orders, get your stuff done quickly, because you don't know how, futures could move on you 10, 15 handles in a clip. So, we've got, regular mode, I guess, and then we've got high vol mode. And so when we're in high vol mode, we may move our adjustment points. We may give things a little bit more room, or we may be, we may adjust and play defense a little earlier, because the objective, especially when you're short premium, is you're dealing with short gamma, and that's not a good thing. I mean, theta is great when it's working, but these are the times when the gamma, like Matt said earlier, the long option people are winning the game right now. So if you are a premium seller and you're trying to get income in your portfolio, this is where you make your money, really, in my opinion. This is what separates the people who are going to make it or not make it, because it's when you have the perfect marketplace, anyone can sell a put and make money. I mean, that's what I've always said. It's can you sell a put during those times and continue to, and then defend those puts during these times that will separate you, and you'll be able to stay in the game much, much longer.
Yeah, it's the old adage, right? Selling puts, it works until it doesn't. You have to have a plan for weeks like this when it clearly doesn't. And you have to have some other strategies, or perhaps just keep your powder dry, or get a little bit more savvy with some of your strategies. Speaking of getting savvy, Mr. Matt, I know you like some interesting ways to pay for that protection out there. You kind of just mentioned put spreads out there. You've talked about interesting things like ratios in the past too. So if an advisor is coming to you right now and saying, hey, I want to hedge my, let's say, SPY portfolio, but it's a wee bit pricey, what are you recommending to them right now, sir?
Yeah, so I mean, I like a caller, but again, I think in these types of environments, doing a straight selling of a call, you're going to miss some violent moves upwards. So you could still get a fair amount of premium by doing a call spread. So a call spread, put spread, caller, something like that for protection, and you're selling options around it. If you're a little bit more sophisticated, a regular butterfly and then moving one of the legs out a little bit, you could actually collect some premium without much risk, and then it tends to give you a chance to get out if it goes against you. So those are the two things that I like to do. Like now, I won't do like a naked caller. I would do more of a put spread caller, because in a call spread caller, because of the violent moves that we're seeing. And also there's so much, there's just so much premium now that, you have to change your strategies to, a high vol environment like Chris is saying, Mark.
Yeah, we're all kind of in, as to use the old term, a fast market these days, as things are whipping and rolling around out there. So yeah, a lot of different ways you can do it. Matt likes his butterflies as well, but let's just overview really quickly. Basic long put, it's attractive, it stops you out effectively, reliably. You don't have to worry about overnight risk. Whatever level you buy, whatever strike you buy in, you're stopped out there. Of course, the downside is that's extremely expensive. So now you have to explore ways to really pay for that. The most basic way, of course, being the basic long put spread: buy one put out of the money, sell one farther out of the money put against it. Is not going to offset all your costs, but as Matt said, if you're judicious with where you line up on the skew there and on the strikes, you can do better than perhaps you might think. And then you can start playing with it a little bit more. The collar is one of the most popular strategies for a lot of advisors out there, buying a put and then selling a covered call against it. Not going to pay for all of your put, going to pay for a good chunk. You could augment that with turning that collar now into a put spread. So now you bought one out of the money put, sold a farther out of the money put against it, and also sold an out of the money call against that. And you can always play with the months and the durations there. Maybe push your put a little bit farther out, 3 months, maybe 6 months. I know Chris and the folks at Swan like to go out a couple of years with their puts, and you keep the premium selling ends very near term, so you play with the decay. That way, there are a lot of ways you can augment these strategies, listeners. We're kind of just giving you the basic overview right now. You can also turn that into a ratio put spread, buy one, and then if you are comfortable in this environment, getting long more of, in this case, S&P at a particular strike. You say if it drops below, we were just talking about 3,000 earlier. You say to yourself, hey, if it drops below 3,000, I want to buy more, then you can indeed sell two puts at that level. So you have the one-to-one put spread and then an additional put that you're short. That will, of course, get you long at that level below it, but also it will reduce a lot more of the cost of that put. And then, of course, you can wrap it all up together with the collar. So now you have the collar where you're selling the covered call, you're buying one out of the money put, selling one out of the money covered call, and you're selling two farther out of the money puts against it. So there are a lot of different ways you could play with this strategy, playing with the duration, playing with the times, playing with the number of short premium legs that you have to try to offset the cost of that put. But bear in mind, you probably will have to do something in this environment to really hedge successfully. Let's go back around the horn really quickly and get people's just final thoughts here on hedging in these kind of pandemic spooked markets right now. Let's start with you, Eric, because you kind of brought it up. You said people are coming to you these days at the various events that you go to, and these are the environments when the options guide tends to be a little bit more popular, when people pick up the phone when you call, when they stop by your booth. So what are your thoughts, Eric, on advisors out there right now who are perhaps considering hedging in this environment, and maybe your thoughts on some of the strategies I just outlined there, maybe the pros and cons, or maybe you have an alternative suggestion. If so, sir, have at it.
Well, Chris said it really eloquently as well. Look, it's expensive right now, and I think that's one of the things that sort of deters some advisors. But, in situations like this, we look for these kind of things because, just as you said, Mark, it sort of does bring the masses maybe over to the booth. Or this is a selfless shout out to the investor services group in Chicago, the 888 options guys, which we all know, to please encourage your listeners to use that service through the OIC. I think at times like these, it refocuses some advisors who might have been on the fence. Matt obviously, is talking about the collar as well, and that was with a little more sophistication. Some of the advisors who were there at this conference we're talking about, who've been in the business a little bit longer, have focused on that. But again, I think the overall theme is that at times of uncertainty and some of this, kind of real strong volatility, it does. I hope it's not short-sighted with advisors. I mean, and I think I'm picking up sort of some of what Chris and Matt are saying is that they really shouldn't be short-sighted. Matt talks about going further out, and I think advisors are sort of contemplating that, where they're as we know, Mark, that cliche, options provide options. So that there are some of those, it's not a one-stop shop. There are other types of strategies that you can mix together that the client and the advisor together need to know, what really do they want to, what is their ultimate goal? And if it's a short-term situation, they got to be careful about what they're doing.
Mr. Director of Risk, same question for you, sir. Some final thoughts for the advisors out there who may be thinking about dipping their toes into the hedging waters these days, sir.
Well, I don't think it's too late, but I do think that at these levels anyways, you have to be cognizant of taking too much long exposure, right? Long Vega, if you will. So spreading it off is a very good idea at these levels. If the volatility if you get some relief rallies, like, usually you should see in normal trading markets, remember those guys where things used to go back and forth? There could be some opportunities there to pick up some volatility, if you can kind of get in there and time that. And I agree with Matt 100%. I didn't mention it, but if I would be very, very careful about putting a straight up collar where you're short calls. I mean, some of the most vicious snapback rallies have been during bear markets and during high volatility times. So the last thing you want to do is, you don't want to get shaken out where, you get one of these snapback rallies for 100, 150 handles, your short call goes in the money, then you're defending that and rolling that and saying, what did I do? And then the market turns back around and drops 200 handles. So that's not a good situation to be in as well. So again, I think caution right now is really what you need to do, especially if you're trying to construct option positions, option strategies.
Matt, you get the final word, sir, for any advisors out there who are intrigued or perhaps intimidated by hedging in these environments. What do you have to say to them, sir?
Yeah, I would echo what Chris says, and also watch out for any naked short units. Do not do that now. And then I'd like to also say that there are Vega plays that are going to move a lot, like the near term, but then the Vega on the far term, maybe 2 years to expiration, they don't move that much. So that, I think, if you want to get something, it hasn't risen that much. That's kind of where I play out in those things, way out of the money. If I think this has another leg down to it. I would say either very long term or do it with spreads for protection. and don't give away your upside. There are some violent rallies that will happen, extremely quickly. You don't want to be in a position where if the market comes back, you've got nothing. So those are the things that I think about in these types of market.
Good. There you go. Good food for thought for everyone out there. And now, speaking of you guys out there, let's get to some of your thoughts with a little bit of our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Welcome to the office hours, the portion of the show where you guys take the reins. We already touched on that comment or that question from Nilay, who liked Matt's prediction from last show on Know About His Models. Now we got Brett. Brett Hayes here wants to know, my clients keep asking about crypto investments, specifically Bitcoin. I can't entertain many of the current products available on the crypto, and he puts exchanges in quotes here. I'm with you there, Brett. They are mostly exchanges in quotes. He says, I can't use the products available on the crypto exchanges for reasons you can probably guess. Would you recommend the listed derivatives on CME or ICE as a point of entry for my clients looking for some exposure? Where do you feel this product fits into standard portfolio diversification? Thank you for taking the time to answer my question. There's a lot of questions in there. One of the things we have pointed out on our Crypto Rundown show is the advent of these new listed Bitcoin options and futures on venues people have actually heard of, namely ICE and CME and a few others. SIBO had them briefly, not so much anymore. As opposed to venues you have to tunnel in through the VPN, particularly if you're here in the U.S. It makes it much more palatable and indeed viable for a lot of advisors like you, Brett, and a lot of others who've written into this program and others with a similar thought. These products are now things you can use in your client's account. So certainly if you are getting a lot of client demand and you are looking for these, those are definitely much more palatable ways, I think, for you guys to go than some of these other products. I wouldn't recommend tunneling into a Deribit, for example, on behalf of your clients. Probably not the best move. Now, there's downsides of that because, of course, they're not the most deep or liquid products yet, so the spreads are going to be a little bit wide. The futures are doing pretty robust volume, particularly over there on CME, but not so much on the options yet, and on ICE, they're both a little bit anemic, so bear that in mind. If you get farther away from front month around at the money, it's going to be pretty wide, so bear that in mind. Hopefully the liquidity will improve, but at the very least, this should remove one barrier to entry for you on behalf of your clients, and that these are venues that you could actually reasonably hope to trade on, and you could use in a lot of these IRA and custodian type accounts and maybe otherwise other venues, other products you simply couldn't use. I know, Matt, you're kind of one of my go-to crypto guys. What are your thoughts here for Brett? And do you think the advent of these new products is finally the entry point for a lot of advisors out there, sir?
Yeah, I mean, you have to be very careful. I mean, one of the things, even think of it like gold. And with gold, you do want to have the physical if the markets really turn sideways and banks start having problems and shutting their doors and everything. You want to have some physical. There are bullion exchanges, et cetera. I hope that starts to pop up a little bit more. I have found one that's doing it for crypto. I don't want to recommend it because for various reasons, but there are some out there that, because I think it is a little bit difficult to own crypto with the, cold storage and all those types of things is pretty confusing for some of your clients. I do think you could get some exposure, though. I mean, even I like to buy GLD or SLV and to get some exposure at certain points. So, I mean, I like having crypto in my portfolio, not a huge amount, under 5%, but still some. To back in the day when it was 100, people were saying it's going to 10,000, and I go, you're crazy. It's never going to 10,000. Where did it go? 10,000. So now they're saying 100,000. So who knows? So. Also, another thing that's good with crypto is, if the Fed keeps printing and the fiat goes south, I mean, you have an asset that isn't as reliant on the banking system. So I think for those reasons, having a little bit, I think it gives you a little bit of peace of mind. It's tough to do it on these exchanges. If you had some background in how to set up a wallet, or they have some pretty sophisticated pieces of hardware that you could carry around. That's interesting. I think that that does a very good service to clients. I wish I had an advisor that knew a little bit more about what to how to get exposure to crypto. So I think start to think about it now as an advisor, learn about it. It's just getting more popular and more popular. As you know, Mark, I've always been ambivalent about it, but it had a little bit. So, I think a lot of people feel that way. So I don't know if that's too rambling of an answer, but that's my position on crypto.
All right, next up we've got N. Gallagher. He wants to know what is the day-to-day like for the director of risk in this risk-off environment? Well, Mr. Director of Risk, you're out there hedging all this risk that's going on right now. So, Mr. Neil, I'm guessing Neil could be Nick, who knows? And probably a lot of our other listeners want to know, what's that day-to-day like? You're out there trying to pay for that protection, sir. What's it like for you these days out there in this crazy, risky environment, sir?
Well, I'll take it from the easy side. Having the hedge on in place before these sell-offs, that's a good thing. You're not much, keep a watch on it and make sure the pricing doesn't get exorbitant, or which would mean an area to sell off or go again, make an opposing trade, if you will. I mean, the challenge, like I said earlier, is really managing whatever short option premium trades that you had on before the events. That's where the risk management comes on. But then also waiting for those opportunities to put more of it on. I'm not saying use leverage or double up or triple up or anything like that. But again, I said earlier, you have to leave some bullets. You can't go into a full position all the time because these events happen and they come out of nowhere. So you have to be prepared for that. So are things a little bit busier on everybody's trading desk right now? Sure. I mean, you threw out that stat with all that volume. So everybody is in, like you said earlier, love the term, haven't heard it in a long time. We're in a fast market right now. So we do have to keep our eye on the screens a little bit more, and no lunch breaks.
No lunch. It's the old school. I used to go down to the pit. I never left. I put an illegal lunch bar, one of those cereal bars, in my jacket. Try to smuggle in some water if possible, because that was all verboten on the floor, listeners. And you sat there, or I should say you stood there all day long. It sounds like Mr. Director of Risk and the crew doing that over there as well. All right, we'll wrap it up with this one from Alan. Alan wants to know, when corporations announce massive surprise dividends, is this accounted for in the options? Or is there an opportunity to purchase puts, take advantage of the expected sell-off in the underlying stock? Thank you. Well, this is a timely one. We had a bunch of questions about, I'm blanking on what the ticker is right now, but this just happened within the last few weeks to a month. We saw a name, I think it was LifeLock. That's the one it was. The Semantic Norton LifeLock, they kind of merged together. And they announced a ridiculous, I think it was like a $12 dividend out of the blue. So everyone started writing into us saying, oh my God, these puts are not reflecting this. This is free money. I'm going to gobble all these up. And what I always do in scenarios like this, for you, Alan, and everyone else out there listening, is whenever you see something like this, a weird corporate action in the name, the first place I go is to the OCC website, not OIC, the OCC, the Options Clearing Corp. And they have a search bar in there. And you type in the ticker. And they hit search. And you see what you find. Chances are you're going to find a circular announcing there's some sort of adjustment to the underlying ticker, which will account for this surprise dividend. And that's exactly what we saw happened with the Norton LifeLock name and most of these other surprise dividends. At the end of the day, unfortunately, there is no free money. It may seem like it. Oh, my God, these puts are not reflecting this crazy dividend at all. But the truth is there's an adjustment probably coming. And if you ever have a question about what's happening in terms of what's happening at a ticker, OCC is the place to go. Mr. Eric, as our duly appointed representative of the OCC by way of OIC, would you agree with that advice, sir?
I would agree with that advice, Mark, and yes, and that's why I kind of gave a shout out to this phone number as well. For those advisors that aren't paying attention and writing down the website, Mark, maybe they'll remember the easy 888 options, because our folks at OIC, the Option Industry Council, and the Option Clearing Corp, but absolutely, Mark, the Option Clearing Corp website and then optionseducation.org, our folks are there actually to answer those kind of questions. And that's what we're here for. Full service.
Full service indeed. Unfortunately, listeners, that music means the service for this episode has come to an end. Hopefully, you found something interesting and worthwhile in this. I know from your feedback and email that a lot of you do. So keep those questions, those comments, those insights, those pearls of wisdom coming. But before we go back around the horn, check in with everybody, see what they have cooking that may interest you, particularly in these volatile environments. Let's start with our friend there, Mr. Cott. You mentioned kind of the OCC website. You guys are always updating and tweaking and adding to that. So if you have anything new there you want to let us know of, by all means do that. Also, if you have any interesting studies, you guys are always working on interesting stuff. Now is the time, Mr. Cott, sir. The floor is yours.
Well, I appreciate being on, Mark, as usual, all the support that you provide to the industry, and kudos to Matt and to Chris as well. One of the things I will say is that Chris's firm, Swan, has also launched a options course through IWI. That there is a course that had been out there already that we worked on in the Investment Wealth Institute. So I highly encourage a lot of your listeners to either go to Swan or go to IWI and take a look at that. I think that really helps kind of reinforce a lot of this, Mark, because there's a tremendous amount of information that gets thrown out. And I think for a majority of advisors, they might want to kind of refresh this and kind of get an opportunity to maybe, up their knowledge. I also would say that relative to the OIC website, we have some tremendous webinars and content that are out there. So I encourage your listeners to go there and frequently kind of kick the tires with our investor services group.
There you go. Check it out. It's optionseducation.org. You mentioned the number, of course, as well, 888-OPTIONS. Not just for retail. Anybody can call that. If you have a question about these adjustments or anything, all these hedging strategies, they'll walk you through all of that and a lot more. And, of course, all that data, all those studies we're always talking about. You want to arm yourself with some data. So when you sit down with your clients, talk about options, you have some numbers behind you, backing you up. Optionseducation.org is the place to go, particularly that advisors tab. Check that out. A lot of great data over there for you. And you kind of invoked the director of risk, so let's start over there next as well. Mr. Chris, if folks are intrigued, they want to learn more, maybe they want to talk to you guys, because you guys do this day in, day out. You pay for hedging pretty much every day, and they want to maybe pick your brain on this. Maybe they want to trade the DRS. Maybe they want to do something else along those lines. Where should they go? What should they do, sir?
Yeah, let me start out. I do want to hit that dividend question again on the next show because there's a couple of great answers and variants to that. So I thought that was a really good question from Alan. Eric already mentioned the 10-part series on options that we have out there, and we've got a couple of new pieces on our website, how to manage loss aversion with clients. Loss aversion is a very powerful yet least addressed investor bias. And then there's another one, how to address recency bias with clients, which is pretty important because, investors place a lot, maybe too much importance on recent information while discounting too much of older information, and that usually leads to poor investing decisions. So all this information can be found on our website, swanglobalinvestments.com.
There you go. Check it out. SwanGlobalInvestments.com is the place to go. And give him a follow on the old Twitters as well, at Swan Global. And last but not least, a lot of you liked his prognostication. Maybe you didn't. Maybe it spooked you. But either way, it came to fruition. Mr. Matt, they want to reach out to you, share their thoughts on your volatility and indeed market prognostications. Maybe they want to reach out for some earnings reports or back tests or all the other fun stuff you guys do over there at ORATS. Where should they go? What should they do, sir?
We have a lot going on. Matt at ORATS.com to get a hold of me directly. We have a new back tester coming out, artificial intelligence to find the timing in our indicators, our great data that helped me look at the market last month. We're creating a fast SMV, a smooth market values feed. So that's there's been a lot of things going on with ORATS, and thanks to our clients for hanging in there, and good to hear from you all that are writing. It's nice to hear the positive comments, Mark.
There you go. You don't always get positive feedback when you're predicting such dire things, but people are in those moods these days. Give them a follow over there at OptionRats on the Twitter, or just ORATS.com, ORATS.com is the place to go. And on behalf of Mr. Matt and the Director of Risk and Mr. Eric, who is nicknameless, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in such great questions. Keep them coming. We love to hear from you guys. And we'll see you back here next month, hopefully with happier news and events to discuss here on the Advisor's Option.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.